Brad Williams, Frugal Finance. Trouble paying your mortgage or facing foreclosure. It happens. Sorry to say that. We're going to talk about what to do in the event that you may be facing a foreclosure, maybe some remedies, maybe some course of action. Are you struggling to make your mortgage payments, or are you already in default? Many people find it embarrassing to talk with their mortgage servicer or lender about payment problems, or they hope their financial situation will improve so they'll be able to catch up on payments. But your best bet is to contact your mortgage servicer or lender right away to see if you can work out a plan. Everything is negotiable. Just stay professional, stay courteous when you do this, have a script, and be patient because you're probably going to have to go through that channel. Always keep in mind, talk to the supervisor, talk to the manager. That's generally what I do. In any circumstance, I'll give the contact person the benefit of doubt. But most likely, I'm just going to want to speak to the supervisor or manager. Why? Because you can get a better reply or response from somebody that knows the workings. And keep in mind, when you call a servicer and you call a lender directly, they either outsource this to a third party overseas, which is a disservice. And then the turnover is high. So just keep that in mind. If you have to step up to the plate more than once, keep a level head. You're already in a point of anxiety level is at peak level, and all it takes is one little nudge and your pressure points are going to explode. And the last thing you need to do is hear another no from the mortgage servicer, and you're going to reach that point. I know I can't speak for your situation. Maybe stepping back. I know there's always a sense of urgency, but just stepping up and making the call is the first step. You never know what the end result will be, but by the end of this particular video, you're going to have a few more resources in your back pocket that you can make some calls to see if there's any assistance. But here, we're going to talk about making mortgage payments, what happens if you miss mortgage payments, what to do if you default on your mortgage, ways you might avoid foreclosure and keep your home, selling your home to avoid foreclosure, accurate reporting on your credit report, filing for bankruptcy, getting help, and avoiding mortgage relief scams. The reporting fraud is pretty much the standard operating procedure. Again, this information, this helpful information, is provided by the Federal Trade Commission. I just want to share this with you. Just for the record, I owned a mortgage company for 20 plus years. I dealt with a lot of people working through foreclosure. Every case is different. Some are workable, some are not. Bottom line, making mortgage payments when you buy a house. In most cases, you get a mortgage loan with a lender. But after you close on the loan, you might make monthly payments to a loan servicer that handles the daily management of your account. I've already talked about that, and I'll leave a link up above here. Sometimes the lender is also the servicer, but often the lender arranges for another company to act as the servicer. If you don't pay your mortgage on time, or if you pay less than the amount due, the consequences can add up quickly. If you find yourself facing financial problems that make it hard to make your mortgage payments, talk to the servicer or lender right away to see what options you might have. The last thing a lender wants to do is go through that foreclosure process. It's timely, it's expensive, it takes a lot of energy for all parties. What happens if you miss mortgage payments? Depending on the law in your state, after you've missed mortgage payments, your servicer or lender can move to declare your loan in default and serve you with a notice of default, the first step in the foreclosure process. Here's what might happen when your loan is in default. You could owe additional money. The servicer or lender can add late fees and extra interest to the amount you already owe, making it harder to dig out of debt. The servicer or lender also can charge you for default-related services to protect the value of the property, like inspections, lawn mowing, landscaping, and repairs. Those can add up to hundreds of thousands of dollars. Default can damage your credit score. Even one late payment can negatively affect your credit score, and that affects whether you can get a new loan or refinance your existing loan, and what your interest rate will be. The servicer or lender can start the process to sell your home. If you can't catch up on your past due payments or work out another solution, the servicer or lender can begin a legal action, foreclosure, that could end up with them selling your home. This process can also add hundreds or thousands of dollars in additional costs to your loan. That means it will be even harder for you to keep up with the payments, make your back payments, and keep your home. Even if you lose your home, you might have to pay more money in many states. In addition to losing your home in foreclosure, you also may be responsible for paying a deficiency judgment. That's the difference between what you owe and the price the home sells for at the foreclosure auction. The foreclosure will also make it tougher for you to get credit and buy another home in the future. Again, they always say this, but lenders, they want more business. So in my experience, this foreclosure, the foreclosure handcuffs, when I was doing this, it was a 2-year period. I may even go in here and it may explain it. Sometimes they used to say 5 years and 7 years. And yeah, it shows on your credit report of 5 or 7 or however many years. But if you've made significant changes to your credit favorably, in other words, you went from a 550 FICO score back up to 680, well, the lender's going to take that into consideration. Clearly, you're going to have to document all that, but I'm not stating that's how it is today. That's how it was when I was doing loans. It could be stricter. It could be less stringent. And I haven't read Fannie and Freddie's guidelines for conforming loans. And I don't know if I want to do that. I don't know if I want to introduce you to those details. They are pretty cumbersome. And it's just paragraph after paragraph after paragraph of if this, then this, then this, what if this? You're just connecting this dot to this over here. And so it's a crooked path if you want to try to understand the foreclosure underwriting guidelines for Fannie and Freddie Mac. Now, on the non-conforming side, I can't speak clearly on that because each lender could have their own underwriting guidelines. They don't have to follow a standard procedure by Fannie and Freddie Mac. We used to be government regulated. Now they're quasi-government regulated. Now the new administration wants to privatize them. I don't know what it is. From your point of view, just focus on your default. You don't care about Fannie or Freddie. What you do want to know is you may be able to work out with the current lender. If you're having trouble paying your mortgage, don't wait for a notice of default. That is really that's just one step before the guillotine drops, okay? Take the following steps right away to figure out a plan of action. Consider contacting a free housing counselor. This information here will be linked below, all right? This information is from the FTC. Let's hope that the information that the FTC is sponsoring is accurate. So here, they're advising you can look up housing counselors to get free, legitimate help and an explanation of your options, okay? Or you talk to a counselor, learn how to spot and avoid foreclosure and mortgage counseling scams. The promise to stop foreclosure. I've talked about the different scams. They're endless. It's up to you to make sure you are speaking to the proper channel. You can see link after link after link here. Why? Because of scammers. So again, you're just covering your rear end. Who knows? Perhaps you were scammed and as a result, you're facing foreclosure. Research possible options on your servicer's or lender's website. In other words, go and do diligence. It requires a lot of work. So see what actions might be available for people in your situation. Read more about ways to avoid foreclosures, to prepare for a conversation with your servicer or lender. Make a list of your income and expenses. Be ready to show that you're making a good faith effort. Here, stress this, good faith effort. Pay your mortgage by lowering other expenses. Answer these questions. It should say what happens when you make or miss your mortgage payments. Do you have any documents to back up your explanation for falling behind? Have you tried to fix the problem? Is your problem temporary, long-term, or permanent? What changes in your situation do you see in the short term and in the long term? What other financial issues may be stopping you from getting back on track with your mortgage? What would you like to see happen? You want to keep the home. What types of payment arrangements could work for you? Contact your mortgage servicer or lender to discuss the options for your situation. The longer you wait, the fewer options you'll have. The servicer or lender may be likely to delay the foreclosure process if you're working with them to find a solution. If you don't reach them on the first try, keep trying. It is going to be a test of patience. Keep notes of all communications with the servicer or lender. Document everything. Document everything. Include the date and time of any contact, whether you met face-to-face or communicated by phone. email or postal mail, the name of the representative you dealt with, what you discussed, and the results. Follow up with a letter about any requests made on a call. Keep copies of your letter and any documents you sent with it. Even if you email your follow-up, also send your letter by certified mail. Return receipt requested. So you can document what the servicer or lender got. Meet all deadlines the servicer or lender gives you. Stay in your home during the process. You might not qualify for certain types of assistance if you move out. Ways you might avoid foreclosure to keep your home. Back in the COVID crisis, there were some protection. Foreclosure proceedings were put on hold, and that no longer exists. So we'll ignore this and we'll just go into what can a lender possibly do? Well, there's a restatement. Consider this option if the problem stopping you from paying your mortgage is temporary. With reinstatement, you agree to pay your mortgage servicer or lender the entire past due amount plus late fees or penalties by an agreed upon date. But if you're in a home you can't afford, reinstatement won't help. Forbearance, if your inability to pay your mortgage is temporary, this can help. With forbearance, your mortgage servicer or lender agrees to lower or pause your payments for a short time. When you start making payments again, you'll make your regular payments plus extra make-up payments to catch up. The lender or servicer might decide that extra payments can be either lump sum or partial payment. Like reinstatement, forbearance also won't help you if you're in a home you can't afford. Repayment plan, this could be helpful if you've missed only a few payments and you'll no longer have trouble making them each month. The repayment plan lets you add a portion of the past due amount onto your regular payments to be paid within a fixed amount of time. And loan modification. If the problem stopping you from paying your mortgage isn't going away, ask your servicer or lender if a loan modification is an option. A loan modification is a permanent change to one or more of the terms of the mortgage contract so that the payments are more manageable for you. Changes could include lowering the interest rate, extending the term of the loan so you can have longer to pay it off, adding missed payments to the loan balance. This will increase your outstanding balance, which you have to pay in the future, maybe by refinancing. Yep, this would be your negative amortization deal. Forgiving or canceling part of your mortgage debt. That would be the ultimate goal. However, don't put a lot of weight on that. Try to be aggressively nice. Yes, is a good approach. Try to get as much as you can. If they're open to negotiating, just ask. All they can say is, no, that won't work. Selling your home to avoid foreclosure. Sometimes you have to do this. If you have a pending sales contract, or if you can show that you're putting your home on the market, your servicer or lender might postpone foreclosure proceedings. Selling your home may get you the money you need to pay off your whole mortgage. That helps you avoid late and legal fees, limits the damage to your credit rating, and protects your equity in the property. Here are some options to consider. Traditional sale. You need to have enough equity in your home to cover paying off the mortgage loan balance, plus the expenses involved with the sale. Your equity is the difference between how much your home is worth and what you owe on the mortgage. If you have enough equity, you may be able to sell your home and use the money to get from the sale to pay off your mortgage debt and any missed payments. To determine whether this is an option for you, calculate the equity in your home. To do this, get the appraised value of your home from a licensed appraiser. You'll have to pay for an appraisal unless you had one done very recently, generally within the last 3 months. Longer than that, you're going to have either recert or a drive-by. The recerts are not uncommon. You could also estimate the market value of your home by looking at the sales comp in your area. You can just go online and you can take a look and see what the market is ballparking. But again, it's only an estimate. You may have done some improvements, or maybe your house is lacking. So just keep that in mind. The question you always ask yourself is, what would I pay for this house? Instead of saying, well, I can throw some ballpark number, but relative to the market, what would you pay for that house? And that's where you're going to determine the top line to the bottom line. In other words, if you have a $400,000 gut feeling that's what the house is worth, and you have a $200,000 loan, well, you have $200,000 of equity. That's a good cushion. The bad thing is, well, you may lose your house, and the other plus is you can pay off all that debt. Have you borrowed against your home? Figuring out the total amount of the outstanding balances of the loans. You may have a first and a second. You may have a third that you've taken out using your home as collateral, for instance, your mortgage, refinancing, or home equity loan. Subtract the amount of these balances from the appraised value of the fair market value, and that'll be your equity, the difference between the two, as I just explained. Now, there are some ways that you're basically going to give the house back to the bank. So you can do a short sale. Selling your home for less than what you still owe on the mortgage is called a short sale. Or you can list your home as a short sale. Your servicer or lender must approve and agree to accept money you get from the sale instead of going ahead with foreclosure. Your servicer or lender will work with you and your real estate agent, set the sales price, and review the offers. Your servicer or lender will then work with the buyer's real estate agents to finalize the sale. In a short sale, the servicer or lender agrees to forgive the difference between the amount you owe and what you get from a sale. Find out if the lender or servicer will fully waive the difference and not separately seek a deficiency judgment. Get the agreement in writing. Go to the IRS website to learn about the impact of a servicer or lender for giving part of your mortgage loan. I might do a video on that. I'll look into it. Consider consulting a financial advisor, accountant, or attorney. Deed in lieu of foreclosure. If a short sale isn't an option, you and your servicer or lender might agree to a deed in lieu of foreclosure. That's where you voluntarily transfer your property title to the servicer or lender, and they cancel the rest of your mortgage deed. Or you're just giving back the property to the lender. Like with a foreclosure, you will lose your home and any equity you built up. But a deed in lieu of foreclosure can be less damaging to your credit than a foreclosure. A deed in lieu of foreclosure may not be an option if you took out a second mortgage or used your home as collateral other loan obligations. Also impact your taxes. Go to the IRS website to learn about the tax impact of a servicer or lender for giving part of your mortgage loan. Accurate reporting on your credit report. Short sales, deeds in lieu, and foreclosure affect your credit. With a short sale or deed in lieu, you still may be able to qualify a new mortgage in a few years. Because a foreclosure is likely to be reported for 7 years, a foreclosure can have a greater impact on your ability to qualify for a credit in your future than short sales or deed in lieu of. I've already mentioned the workarounds there. Again, this comes down to how you recovered from the foreclosure. If you're back on track, if you've resolved all of the previous debt issues, and now you have a pretty clean track record. Okay, divorce can lead to some nasty, nasty outcomes. When you're forced to sell a property or one party just elects not to make the payments, look, it affects both sides of the transaction. You don't know what the outcome of some people. That could have a serious impact, but then after the divorce, you find a new path and your record is squeaky clean after 2 years. Well, you're going to have a really good story to give to the lender, and the lender will take that into consideration. I can't tell you how many times where a potential borrower said, look, I faced foreclosure and blah, blah, blah. I just said, look, we'll dance to this music, whatever the lender wants to hear, we're going to give them whatever they need. If you can tell a great story that's truthful, then there's a chance that you can jump over that hurdle, that foreclosure hurdle, within a short period of time. You've taken your FICO score up to 700 from a 580. Well, the lender is going to look at that favorably, and then you have a cash cushion. Again, it's on a case-by-case basis. It just really depends on how Fannie Mae and Freddie Mac, that underwriting, it's all automated. That's one particular methodology. Back in the day, if the lender elected to keep the loan, they could override Fannie and Freddie Mac and put an exception in there. They'll keep the loan for a couple of years because they think you are a good borrower or good potential borrower because of the story you told and your track record after the foreclosure. Don't ever say no. Don't let anyone tell you no until you push it through the system. Hence, that's why they call it pre-qualification. This is where you're working with a mortgage broker, not a direct lender. And this mortgage broker has 5+ years of experience versus somebody with a 1.5 years or 2 years. You're going to get a better feel. That mortgage broker has enough experience. Well, now, since we haven't seen anything nasty in, nearly 12, 15 years, they won't be that experienced. You need to be with somebody, work with somebody that's been in the industry for 20+ years. If that's the case, you may have to go directly to a direct lender because individuals that work for the big banks, they just hang around. They just do it for 25, 30 years because it's easy money. a bank doesn't want to lose somebody that experienced. So again, you're not going to be able to do this online. You're going to have to go through and actually speak to a mortgage broker or go direct and see, hey, look, just be straight up. How many years have you been in the business? Ask them straight up. Tell me your experience with foreclosures or short sales or deed in lieu, and see what kind of, if there's an and an ah, and say, then you say, thank you very much. Who in your office has a lot of experience with foreclosures? If they and ah, say, who do you know that may have some experience with foreclosures? And again, it just takes a little bit of work. Get a letter from your servicer or lender confirming that your loan closed in a short sale or a deed in lieu agreement, not a foreclosure. That's important because it could just be a quick click. Somebody's just doing some data input. And trust me, when you're 8 hours a day and all you're doing is data input, you're in front of a keyboard, just constantly just typing, you overlook things. So there could have been a little mark and it said deed in lieu, but you've been hitting foreclosures all day long. Perhaps there's a data input and it was entered incorrectly. So make sure you back up, verify this, and send it to Equifax, Experian, and TransUnion, all right? Order a copy of your credit report. Make sure the information is accurate. Law requires credit bureaus to give you a free copy of your credit report at your request once every 12 months. So you're just going to go through and you can ask them. You can go online, annual credit report, and get one from each. You keep track of that. You can also buy a credit report. I don't recommend it, but called a mortgage lender report. They have a more accurate term. I'm not going to confuse you, but I don't know if you can get that thorough of a report as a consumer. But on the lending side, we would get these full-blown consolidated reports that would give us all the information in a long history of your credit. So look into that. When you're ready to buy another home, get pre-approval. And as I stated, you want to talk to somebody that knows something about foreclosures. Filing for bankruptcy, your last option. If you have a regular income, Chapter 13 bankruptcy may let you keep the property, like a mortgaged house, that you might otherwise lose. But Chapter 13 bankruptcy is generally considered the debt management option of last resort because the results are long-lasting, far-reaching. A bankruptcy stays on your credit report for 10 years. That can make it hard for you to get credit, buy another home, get life insurance, or sometimes get a job. Still, it can offer a fresh start for people who can't pay off their debt. I know they're putting a lot of weight on this, but what they say and then what's actually done. Bankruptcy is serious business. No ifs, ands, or buts. This 10 years, it's usually 7 to 10 years. Will a lender step up to a bankruptcy if it is a reasonable bankruptcy? In other words, you were a small business, something happened, there was no recovery. Well, perhaps not only did you lose your business, but you lost everything else along with it. There's that risk-return deal. For some people, they risk it all. They risk it all, and sometimes it doesn't pay off. If you've recovered, in other words, you lost everything, then you started working for another company, and you have a 2-year, 3-year track record of recovery, lenders will look at this bankruptcy and they'll go, okay, we'll take that into consideration. If your FICO score is high enough, then you're going to get a positive reaction. We're driven off of this horribly. And again, I've always thought the credit reporting bureaus are very discriminatory. And that is not only for individuals who have faced some hardship, but on the flip side, what about the true savers? How about the people that believe in frugal side of life, who think consumerism is a lot of overkill, that don't believe in credit cards, but are penalized for not using their credit cards? These people have net incomes that far exceed any reasonable common sense, but they don't believe in borrowing. But when they look at their FICO score, they are discriminatorily low. Why? Because they don't like the debt structure. They don't like the credit reporting bureaus. There's not too many arguments because it's a minority and that's unfair. I think it's a horrible system, but you need some measure in order to standardize. So it's a system, it's there, but I will argue it's not the best system. I haven't given it much thought. This used to really burn my rear end because I've seen so many credit reports, and I would just look to see how discriminatory the bureaus are. That being said, getting help and advice, I've mentioned this again and again and again. You're going to have housing agencies throughout your city, county, and state. They have counselors there. They may have grants. They may have sources, but you won't know until you ask. HUD, they offer grants to these authorities. You just never know what's available for help. But it's a great resource for someone who is an expert in terms of counseling. So don't shy away from that. Okay, Department of Treasury, there's going to be some housing programs. Take a look. Don't get misled. Do not get into a spam possible situation. In other words, when you look at this information and you're online, make sure it says gov. Okay, you see up here? See where the blue cursor is up here? GOV. You have to be a government agency in order to be able to use the GOV moniker. You're going to see this with the state of California or Nevada or Oregon or New York, Florida, whatever. There's going to be something that's going to be recognized as a state agency. Make sure you're in the right path. And make sure when you do this, you typed in the correct information. In other words, spammers will ghost this and redirect. Be careful. If you have a mortgage through FHA or VA, you're going to have to contact them directly. Avoiding mortgage relief scams. Don't do business with companies that promise they can help you stop foreclosure. They'll take your cash and they'll never deliver. Never, 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 ever prepay anyone when you're doing this, ever. Don't pay anyone who charges upfront fees, ever. All right, there's only one exception, and it had to do with the prepayment of, and this was long, long, long ago. This was before there were so many scammers. I would ask for the cost of the credit report and the cost of the appraisal. And as I move forward, I told all my clients, you're just going to pay the appraiser when they're doing the appraisal. I'm not asking for any money. And then the only thing I would ask for, and this was when credit reports were $55. They're probably triple that now. And so I just say, look, I have to run a credit report. I just need you to pay $65. Today, I would probably work out something where I do not ask for any money up front. Again, I haven't done a mortgage loan in a while. So I would have to come up with a different way. I would not want to ask anybody for money up front in this era. And don't pay any money until a company delivers the results you want. That's the law. In fact, it's illegal for a company to charge you a penny ahead of time. A company can't charge you until it's given you a written offer for a loan modification or other relief from your lender, and you accept the offer and a document from the lender showing the changes to your loan if you decide to accept your lender's offer. And the company must clearly tell you the total fee it will charge you for its services. Look, it's complicated. This whole mortgage thing and borrowing is very complicated. My videos are long, and I apologize. It's just the details are complex. And sometimes we step into a situation where you're talking to family and friends, and they think they know the industry, and they say, look, just sign this document. You're making plenty of money. Don't worry about it. Well, it's none of their business. They're not making that payment. It's you. You're responsible. With that being said, share with me if you know of anyone that has faced this situation, whether you have gone through this process, where you are today, and any suggestions that you can make. Pass it on. Let people know that there is recovery. It takes a while, whether it has scarred you to the point where you're saying, I'm only going to rent the rest of my life, or it was a hard lesson learned, share what worked for you, or whether you think the process is unfair or it's fair and you just made a few mistakes. Let me know if this is helpful. Subscribe, do that thumbs up thing. Give me your comment, give me your opinions. Brad Williams, Frugal Finance. Williams out.